Is it just me, or does something not feel right about the stock market? Last year, we announced global tariffs and the stock market crashed, and then it broke new record highs. Then we got the news that the job market in the United States is not doing so hot, and the stock market went down. But then it broke new record highs again. Now, the United States recently attacked Iran. It began major combat operations in Iran. Immediately after that, we saw oil prices spike. We saw airports around the world shut down, and we saw the stock market get hit. And now investors are counting down the days until the stock market breaks new record highs again. Here's the reality. A lot of people are investing their money, putting money into the 401k, thinking about retirement without understanding how these changes in our economy can impact their wealth or ability to retire. And that's what I want to break down in this video, because there are a few red flags in the stock market that most people are completely overlooking that I want you to understand as an investor. That way you can not only protect your wealth, but also see how you can grow it even faster. Now, before I get into the 3 broken things about the stock market, I want to remind you that for those of you that are investors and you're feeling a little bit concerned about your retirement or investments because of all the chaos happening in the economy, I want to remind you that on March 18th, I'm hosting a live, free, and virtual investor workshop to show you not only how you can protect your investments through all the craziness, but also how you can find investment opportunities to grow your wealth through all the changes in our economy. Not just with the geopolitics, but also with technology and changes with monetary policy. All these things create opportunity for the bony savvy. That's why I'm doing 2 live workshops on the 18th. Once in the morning at 10:30 a.m. Eastern Time, and again in the evening at 8 p.m. Eastern Time. Now, it's free. And when you actually show up live, you're going to get a copy of this book, How Money Changed Forever, that my team wrote. You're going to get a digital copy of this book emailed to you for free when you actually show up live on the workshop. So, if you're interested in seeing how you can invest your money better in 2026, I have the link for you down in the description below. Reason number 1 is that the stock market and the economy are living in 2 different worlds. And there are 2 numbers that I want you to pay attention to. The first number is $1.28 trillion. This is how much credit card debt that Americans have today. It is the highest amount that we've ever seen, and it's 66% higher than where we were back in 2021 when credit card debt was actually falling. The second number I want you to pay attention to is 7,000, because the S&P 500 just crossed 7,000 points for the first time in history. You can start to see the problem. The average American is seeing more pain, while the financially savvy are becoming more wealthy than ever before. This is what's called a K-shaped recovery, which is what we're seeing today. What that means is before the pandemic, our economy was doing okay. And then the pandemic hit, the economy went down. And then after the economy went down, we saw things recover a little bit. And then we went through this K-shaped, where some people became incredibly wealthy, and others became a whole lot poorer. And what we're seeing is that more and more Americans, the average American is becoming poorer. The middle class is becoming smaller, because people are struggling more and more because of the higher cost of living. Because people don't have money to invest, because they're spending all their money on their rent and their groceries. And then the people that are the financially savvy, the investors, those are the ones that have become wealthier through all of these changes that have happened in our economy. The second reason why it feels like something is wrong in the stock market is because now our government has an active stake in the stock market. And this started during the pandemic, but it accelerated in 2025. I'll show you. In 2020, when the pandemic hit, the Federal Reserve Bank flooded our economy and the stock market with more money. And this isn't me just coming up with a conspiracy theory. This is what the Federal Reserve Bank said. Take a listen. Fair to say you simply flooded the system with money? Yes, we did. That's another way to think about it. We did. That was Jerome Powell. He is the chairman at the Federal Reserve Bank, which is the central bank here in the United States. And what he said was that the Federal Reserve Bank printed a whole lot of money out of thin air. They created this money, and then they injected it into our economy. They injected it into our stock market. When the Fed did that, it felt good at first because everybody had more money. The stock market was booming, salaries were rising. And then what happened is people realized that this money doesn't have as much value as it did before because you can't just print more wealth out of thin air. We can print currency, and this currency is really just a piece of paper. So they started printing more paper, and people realized that this paper didn't have as much value as before. So now the cost of living started to go up. Inflation started to become a problem. And that was when in 2022, the Federal Reserve Bank changed again. They said, okay, inflation is a problem, and now we're going to try to fix the inflation problem by pulling money out of the economy. In the technical term, it is tightening the balance sheet. Because when the Federal Reserve Bank was stimulating, that was called quantitative easing. It was expanding the balance sheet. That's all that means. But in reality, that just means money printing. 2022, the Federal Reserve Bank now wanted to pull money out of the economy through something called quantitative tightening. And that's what they did in 2022, 2023, 2024, and through most of 2025 as a way to cool inflation down. Now here's the thing you have to remember. When you try to cool inflation down, it doesn't reverse the effects of inflation. It just tries to slow down future inflation. So now the average person saw their salaries grow, but the prices of things grew even faster. And now the Federal Reserve Bank is trying to slow inflation down. But for most people, the prices of things are continuing to rise faster than wages. And then comes 2025, and the Federal Reserve Bank says, hey, inflation is now at par with people's incomes. Maybe incomes are a little bit higher. So we beat the inflation war, but don't forget we had 5 years of inflation beating wages. So the average person became poorer. And that was when in 2025, December 1st, 2025, the Federal Reserve Bank said, we're going to start the money printer again. Because on December 1st, 2025, the Federal Reserve Bank started quantitative easing again, meaning they started printing more money to inject it back into our economy and markets again. So yes, as of right now, the Federal Reserve Bank is working to stabilize markets by printing money and injecting it into our markets. But that's not all. The United States government is also getting involved with the stock market by investing in stocks in the stock market. Now, before 2025, the United States was not an active investor in the stock market. It was a regulator of the stock market. But then in 2025, as a way to compete against China, the Trump administration said that we want to invest in specific industries as a way to help these industries grow. That way we can be less reliant on China. So, what we saw happen was the United States government started investing tax dollars into specific stocks on the stock market to help certain companies boom. We saw the United States government invest hundreds of millions of dollars into the MP material stock. But that's not all. We then saw the United States government invest billions of dollars into the Intel stock because they want to see more chip manufacturing here in the United States. But that's still not all. After that, the United States government invested tax dollars into Lithium Americas, which is a lithium mining company, and then into another company called Trilogy Metals. The average investor cannot compete against the United States government because the government has infinite pockets, because they can just raise their taxes or work with the Fed to print more money. And this is where now the government has a vested stake in the stock market, while the Federal Reserve Bank is working to pump up the stock market. And then we have this idea that diversification is also changing. Many investors, myself included, are invested in the S&P 500. And when you invest in the S&P 500, the idea is you are investing into a diversified group of stocks in the stock market because you are investing in the 500 largest companies in the stock market. Well, we're starting to see that change as well because the largest 7 companies out of these 500 make up more than a third of the stock market. It's about 34% of the S&P 500, while the other 493 companies are making up the other 2/3 or so, 66% of the stock market. Just take a look at this chart. This red line right here shows the Magnificent Seven as a percentage of the S&P 500 market cap. And what you can see is that over the last decade, the Magnificent Seven stocks have taken up a bigger and bigger share of the total market cap of the S&P 500. Now, this doesn't mean you shouldn't invest in the S&P 500. You have to understand how this is going to impact your diversification. Because now when you're investing in the S&P 500, you're really not getting a ton of diversification. Because what you're doing is you're investing in the Magnificent Seven, and then a little bit of these other 493 companies. And the reason why this is so important for you to understand is because last year in 2025, these 7 companies drove more than 40% of the entire S&P 500's return. That's great when things are going well. Because in 2025, if you invested in the S&P 500, you made a lot of money. But what happens if things go down? Because now if we're just relying on these 7 companies to carry the entire S&P 500, if these 7 companies go down, that means the entire S&P 500 could go down. So it becomes more risky in that sense. And many investors who are investing in the S&P 500 don't understand that risk, or how it can impact diversification. And that's why it's important for you to understand this. Not so you avoid the S&P 500, but so you understand how you can position your portfolio. That way you could protect yourself in all different stages of the market. So what we talked about so far is how resilient the stock market has been regardless of what craziness has happened in the economy. But there are some weird things that have been happening in the stock market that make it feel not so normal. And the reason why is because, number one, our market is not the economy. We are seeing the average American struggle more with credit card debt breaking new record highs, while the stock market continues to be at or near record highs, even despite the recent craziness. Then number two, we talked about how we're seeing the government get more and more involved with the stock market. Ever since the pandemic, we saw the central bank get more involved by doing more money printing, quantitative easing, to print money and inject it to stabilize markets. Well, that stopped in 2022, and it stayed stopped until December 1st, 2025. But then that turned off. We saw now the Federal Reserve Bank start the money printing again on December 1st, 2025, and it is continuing to happen today as a way to stimulate and stabilize markets. While at the same time, the United States government in 2025 started to have a vested stake in the stock market by taking tax dollars and investing it directly into the stock market, which you bet can help boost markets. Then we talked about number three, how diversification in the stock market is not what it used to be. Because right now we have a lot of concentration into the magnificent 7 companies in the stock market. The 7 largest companies in the stock market, which, by the way, are all involved with tech and AI. So that's something you want to be aware about as well. So while many people think that they're investing in this to have diversification, in reality you're investing primarily into the magnificent 7, and then a little bit into the other 493 companies. Again, this doesn't mean you shouldn't invest in the S&P 500. This means you need to understand what's happening. This is why, again, on March 18th, I have my live investor workshop, which if you haven't registered for yet, I have that link for you down in the description. But this does not mean you shouldn't invest your money. This does not mean you should avoid the stock market. This means you have to understand how to invest your money, because regardless of the volatility, regardless of what happens, we know that asset prices go up over the long run. And if you want to think about investing, you want to think about retirement, you have to be investing your money. And then you have to understand how you can use the volatility, how you can use these changes to your advantage. Because the reality is, all of these things create opportunity for the financially savvy. All of these things create the ability for people to grow their wealth a whole lot faster. Because if we see growth in the markets because the government, the Federal Reserve Bank, is pumping money in, you have to identify how that creates opportunity. If you see this lack of diversification, there are other ways to diversify your money which can create other opportunities for you. And that's why it is important for you to be a financially savvy investor. So again, if you got value out of this video, the best thank you was a referral. So if you could please share this video with a friend, family member, colleague, or fellow investor. That way we can continue to spread this type of financial education. Thank you. President Trump just confirmed that he wants to get rid of your income tax. Take a listen. I believe that tariffs paid for by foreign countries will, like in the past, substantially replace the modern-day system of income tax, taking a great financial burden off the people that I love. Morning.